Welcome to FinBot Insights. Covered call ETFs promise something deeply alluring, especially for income investors: high, consistent monthly yields. In this explainer, we are going to build a rigorous framework to understand exactly what you are sacrificing to get that income.
So you see that promise of a steady 8% income stream. It is a powerful idea, but it is never free. The critical question is whether the price you pay in potential growth is actually worth the yield you receive. This analysis is designed to give you the tools to answer that exact question for yourself.
To really understand why these funds became so popular, you have to look at the world that created them. For more than a decade, we lived with rock-bottom interest rates. This created a genuine crisis for anyone seeking income, leading to this narrative of "there is no alternative," or TINA. It drove a desperate hunt for yield wherever it could possibly be found. And that hunt for yield fueled an absolutely explosive amount of growth. By 2023, assets in the flagship covered call products had ballooned past a staggering $50 billion. They transformed from a niche strategy into a mainstream component of many portfolios. Okay, so let's get into the engine that drives these products. To understand them, we have to examine their core mechanic. At its heart, it is a very straightforward transaction. You are explicitly trading away your potential for future growth in exchange for immediate income. The engine that actually generates this income is a financial instrument known as a call option. The fund sells these options and collects cash, which is called a premium. That premium is then what it distributes to its shareholders. And right here lies the fundamental trade-off. Owning a stock offers theoretically unlimited upside. Implementing a covered call strategy surgically removes that unlimited potential. You are explicitly selling your claim on massive gains in exchange for a known, upfront cash payment. The process itself is very methodical. The fund owns an asset, it sells a call option against it, and it collects the cash premium. In doing so, it agrees to cap its own upside, transforming a growth asset into an income machine with a predefined ceiling on its potential profit. Now, this mechanical trade-off has profound implications for performance. The strategy's effectiveness is not universal. It is acutely sensitive to the prevailing market environment. A direct comparison makes the differences incredibly stark. A traditional equity ETF is designed for full upside participation. A covered call ETF, on the other hand, is what we call short volatility. This means it profits most when markets are calm and moving sideways, and it underperforms when markets trend strongly in either direction. Performance is therefore highly conditional. In a raging bull market, the upside cap becomes a significant drag on returns. In a sharp bear market, the premium collected offers only trivial protection. The strategy's true sweet spot is a flat, range-bound market where premiums can be harvested without forfeiting major gains. And this is not just theoretical. Consider the post-pandemic bull market of 2020 and 2021. The mechanical nature of the covered call strategy meant that funds like QILD systematically capped their gains, leading to dramatic underperformance compared to the underlying NASDAQ 100 index. This brings us to the most critical part of our analysis. We must now deconstruct the high yield itself and ask a crucial question: where is the money actually coming from? Is this high distribution a sign of superior investment performance, or is it an accounting illusion, a simple reshuffling of capital from the fund's assets back into your pocket? The key concept here is return of capital, or ROC. Unlike a dividend, which is a share of a company's profit, ROC is not profit at all. It is the fund simply returning a portion of your own original investment back to you. It creates the illusion of income, but no new wealth has been generated. You see, a fund's distribution has three potential sources: dividends from its stocks, premiums from selling options, and a return of your own capital. When the first two sources are insufficient to meet the advertised high payout, the fund must dip into its own net asset value to make up the difference, effectively liquidating a small piece of itself to pay you. These factors lead to the single greatest risk for a long-term investor in these products: capital depletion. If the total distributions paid out consistently exceed the fund's total return from premiums and asset growth, the underlying principle erodes. This is a direct threat to both future income and long-term wealth. So, given these significant trade-offs and risks, we can now define the precise and appropriate role for these instruments within a portfolio. These ETFs are specialized tools, not foundational building blocks. Their proper role is as a smaller, tactical holding to generate cash flow in a conservative portfolio. They are fundamentally unsuitable as a core holding for long-term wealth accumulation. So the final verdict is this. You are sacrificing what is known as equity convexity. This is the powerful asymmetric potential for stocks to produce accelerating explosive gains during rallies. You are trading that potential for a predictable but ultimately limited and linear stream of cash flow. This leaves every investor with one critical question. Are you truly harvesting income, or are you simply harvesting your own principal? A high yield funded by capital depletion does not create wealth. It is merely an illusion created by converting your asset base into cash. Finally, a necessary disclaimer. This content is for informational and educational purposes only and should not be construed as financial advice. Do not trust social media influencers, including this channel, for your investment decisions. Every investor's situation is unique, and you should always conduct your own research. If you found this rigorous breakdown valuable, support our work by clicking the like button and subscribing for more in-depth financial explainers from FinBot Insights. Thank you for watching.